Bloomberg Tech is live from coast to coast with Caroline Hyde in New York and Ed Ludlow in San Francisco.
This is Bloomberg Tech. Coming up, Disney shares sinking after giving a tepid growth outlook. That's as the market awaits news on who will be its new leader. Plus, Oracle raising more debt as the software giant looks to raise $45 to $50 billion in bonds and equity for additional cloud infrastructure capacity. And sources say Elon Musk is in advanced talks to combine SpaceX with XAI. We'll have all the details, but first we check in on these markets that in certain areas breathe some sighs of relief. After sell-off on the Nasdaq, on the S&P 500, we're actually seeing a bit more of the buying of the dip when it comes to stocks. Not so much when you're looking at commodities. We're up 0.7% when you're looking at the Nasdaq. Now, Bitcoin bounces, but boy, did it feel the pain over the course of the weekend. We're only trading at 78,000. So still the pressure on so-called digital gold as we actually see that continued strain on gold and silver that really catalyzed on Friday and the decision of who will be the next Fed chair. Move on to the individual stocks. Nvidia is one of the biggest points drags to the downside today, off by 1.4%. We're going to dig into what really its relationship with OpenAI and how much it's committing to funding it is going to look like. We're looking at Oracle, now up 2 percentage points. It's selling a whole wealth of debt and equity, but does this steady the nerves that it would in some way tempt junk status on its debt? We're getting into that a little bit later. Move on though, because in the here and now we're looking at earnings. And it was tepid growth more broadly that we saw for Disney. And that in particular seems to be being pointed forward to this fiscal quarter that we look at. What is the worry about people not traveling to as many of the parks in the year to come? We're currently off by 4%, as you say, on the intraday basis. But interesting news over the course of the weekend as well about management. Felix Gillette joins us now. Just going to the fundamentals of the business. The quarter they just reported was strong, particularly in streaming, but it seems to be where we're going in parks, which is a slight nervousness.
Yeah, I mean, they just reported record sales in parks for the previous quarter. They hit $10 billion of sales in the quarter for the first time. But they offered this outlook today that said, in the current quarter, there are some concerns. There's all this, volatility in terms of the international market. Are they going to have as many international visitors to the parks? They're going to shift some of their marketing to try and attract more domestic visitors to the domestic parks. There's also increased costs. They're launching a new cruise ship. They have a new Frozen exhibit opening in the parks in France. So, the parks outlook for this quarter is not as good, coming off a very strong quarter.
Interesting time for parks, though, and its leadership, because we understand there's a key vote going on at the board level this week.
Yeah, so the board is meeting. They're expected to vote on Bob Iger's successor. We've been watching this for 3 years now. They are leaning towards Josh D'Amaro, who's the head of parks, and we're expecting to see that vote this week. Disney had previously said they're going to announce a successor for Bob Iger sometime before the end of March. So things are moving forward, and it makes sense that Josh D'Amaro would be in the lead at this point. The Parks and Cruise division is providing the vast amounts of profit at this company, and it sort of reflects where things are at. The experience is really working well for consumers right now. And yeah, as we've talked about, the home entertainment is still somewhat tumultuous as we make this transition from cable to streaming.
Felix Gillette with the best write-up. We so appreciate it. Thank you. Meanwhile, Disney CEO Bob Iger did talk about their IP, saying there's no rush to acquire any more of it. Here he is in today's earnings call.
I think we have a great hand. I don't really feel that we have a need to buy more IP. We're just going to continue to create our own, and we've got an unbelievable bedrock of stories already told to grow from.
Let's dig into Disney, streaming landscape, and more with Daniel Payne, his Slate Stone Wealth CIO. Just for a moment, we're just talking about how important the parks are. But from the streaming side, it had a really good innings in terms of profitability, finally, in terms of the previous quarter just reported on. But push us forward.
Yeah, really good from the entertainment standpoint. And that's where they see a lot of their operating leverage in the company. But we do believe moving forward, there are a few catalysts out there on the experiences, which is their parks and cruises, over the course of the year that really could be beneficial to shareholders. The near-term concerns, which they mentioned for the first quarter because of international travel, might be pressuring the stock today, along with the management changes. There's a lot going there, under the hood. But bottom line is, we got massive stimulus coming down the pipe in this country with the tax cuts, with the One Big Beautiful Bill. We're going to have about $150 billion of tax refunds for consumers. And the U.S. consumer, they've proven over and over again that if they're halfway confident with their job and they have excess money in their pocket, they're going to spend it. So that could be a catalyst moving forward once we get into summer. And another thing that nobody's really talking about is that this summer we have a few events that are kind of unique for this country. We have the World Cup here this summer, and we have the 250th anniversary of our country, which is going to be a lot of stimulus in and of itself. I've seen some projections that the World Cup is going to generate about 6.5 people coming for the event. It's going to generate roughly 17 billion in GDP for this country. And, with those kind of visitors, who's not to say they might stay a little bit longer and bolt on a trip to one of the Disney parks moving forward. So I think longer term, there could be some catalyst to get this stock out of the funk that it's been in over the past 4 years under the current management.
We'll talk about management and current management. How do you feel about maybe the person who's helped drive the parks business becoming the CEO of the whole business again?
Well, that could be the reason why we've seen some weakness today, because it could be like, here we go again. Because if you remember back in 2020, we had the same thing happen when Iger, placed his handpicked successor, Bob Chapek, in control. And, unfortunately for Chapek, he was put in control of the entire operations in February of 2020. So we know exactly what happened a month or two later. It's kind of hard to run a company when the whole economy shuts down and discretionary spending comes to a halt. So, that might be kind of unfair to judge Chapek on that, but there could be some nervousness with investors by doing the same thing once again, putting the head of the experiences, which again is parks and cruise line and gaming, ahead, at the charge of the company. So there might be some hesitancy there, but I will say Disney over the past 4 years has nearly doubled their EPS, but yet the stock has been essentially flat. So we've had massive valuation contraction. And if they get the right person in charge that can pull the various levers of this company, we can have a premium brand once again trading at a premium valuation. So right now, the stock trades at roughly 17 times 2026 earnings estimates of about 660. If a market multiple is placed upon this premium brand, the stock could get into the mid 150s with pretty much ease. And so that is significant upside potential if the right person can make the right decisions moving forward.
If we hear it's Josh, and we know the board is voting this week, and then they've promised us that we would hear by the end of March. If that's the case, then where do you think they can drive the realization that their IP is worth so much more, that the spending isn't having to just go up and to the right when they're trying to market the latest Avatar movie, or when they're having to really pay top dollar for sporting events? I mean, you just went at length of what the soccer means for the US more broadly, but when you're trying to stream it or show it, it gets very expensive.
And that's the problem with that side of the business. There's significant operating leverage with the variable cost. And, you spend all that variable cost money up front, and it's almost like you build it and you hope they show up. And so, if you get the formula right, you spend the money on the content and it's a success, then that's significant leverage for the earnings growth of the company. And that's kind of the factor that investors are weighing right now, especially with this change in leadership, because it just adds uncertainty to the stock. But, once again, and uncertainty leads to opportunity, and their opportunity is how you make money in the stock over a market cycle.
Daniel Payne of Slate-Stone Wealth, appreciate you coming on today. And coming up, the US, it aims to slash its reliance on Chinese rare earths and other metals. We'll tell you all about the plans for the first of its kind stockpile for the US private sector. That's next. This is Bloomberg Tech. President Trump, well, is set to launch a $12 billion stockpile of strategic critical minerals. The move is set to counter US reliance on Chinese rare earths, but it sent prices for related companies higher. But it's all according to sources thus far. Let's bring in Bloomberg's tech editor in DC, Mike Shepard. Tell us about this first of its kind store for US private sector. What do we know is set to potentially be announced here, Mike?
Well, what we're looking for is the U.S. Export-Import Bank to take a vote later today on approving this package. The private sector will kick in about $1.67 billion as part of this seed money, and the U.S. Export-Import Bank will kick in another $10 billion, and this would be the biggest such deal in the bank's history by far. And it really is a sign of just how much the administration is pushing in this area of rare earths and critical minerals and trying to wean the U.S. from its dependence on China as a key source for these inputs. They're so essential to the private sector, to autos, to iPhones, to gas turbines even, and without access to them, we risk seeing a manufacturing supply chain disruption akin to what we risked experiencing earlier last year when the Chinese government started to impose some of those export controls on rare earths. So the U.S. is trying to diversify around it and ensure both pricing stability and supply stability here, Cara.
Senior administration officials have been detailing what could be announced. But what's interesting, Mike, is sort of which countries are we going to be sourcing from, and what sort of backstops do the Export-Import Bank need to know that they can sell this on correctly and not be landed with an awful lot of minerals?
Well, the idea is to ensure that U.S. manufacturers have this access, and it would create this stockpile akin to the Strategic Petroleum Reserve here that manufacturers here in the U.S. could access as needed. They would have to pay into it to be able to eventually make purchases and then promise to replenish it down the road. But this is just one of several steps in the area of rare earths that the U.S. government is taking right now. Later this week, there will be meetings with dozens of foreign ministers here in Washington to agree on trying to find some way to create a mechanism to stabilize prices and supply around the world, not just here in the U.S., but with allies, so that collectively they can reduce some of their dependence on China and increase extraction, mining, and refining in a number of other countries. While we call them rare earths, they are actually fairly common. It is just that they are not extracted or exploited in as many places as they are, and to the extent that China has come to dominate the market. And, Cara, the clock is ticking. Remember that the trade truce that the president signed with Xi Jinping late last year, it's only good for 1 year. So they have to start making these moves to ensure that supply won't be as disrupted as it risked being facing earlier last year before the trade agreement.
We'll see how Project Volt, as it's known, continues. Bloomberg's Mike Shepherd. Thanks
right.
for detailing all of this. Let's get the broader economic picture now. Let's talk about what's moving tech stocks in particular. Natalie Gallagher's with us, principal economist and director at Board. Just going back to that rare earth suggestion, is that positive? Is supply chain a real headache for the businesses out there right now?
Yeah, absolutely. You know, what we're seeing is a fundamental shift in how the U.S. has really been addressing supply chain resilience over the past few years, and absolutely top of mind following the export control measures by China back in 2025. You know, what in essence we're doing is we're creating a strategic reserve of rare earth minerals for the digital economy, which means that we're less at the behest of foreign entities as we try to continue to move forward, right, in AI innovation and all the potential for the economy that really houses.
A lot of the focus has been not so much on supply chain of rare earths as well as that, but also really just the bottlenecks that we see in delivering the AI hope and euphoria that is built into the market, whether that's power, whether that's energy, whether that's land. Natalie, where do you stand in terms of the reality of AI and what has been thus far driving a lot of stock shares higher this year?
Yeah, absolutely. I mean, 2025, we saw a really intense increase in valuations. There's a lot of hope in what AI can deliver. We heard that at the Davos Economic Forum, also loud and clear by many key tech and political leaders as well. Now, in order for these valuations to hold in 2026, and what we're really going to have to see, and it's going to sort of earmark the year, is a close, right, in the gap between how much is being spent on AI and the ROI that we're actually going to achieve. If we get those productivity gains, then this is absolutely a great story of foresight. If we don't see those productivity gains, then we're going to have a conversation much more housed around capital misallocation.
But Natalie, how's that going to show up? As an economist, are you looking at jobs data? I mean, because at the moment, all we're seeing is jobs cut upon jobs cut, which in some way seems to be going back to AI.
Yeah, I mean, it's fascinating, right? What we're seeing in the overall jobs data, I'll first sort of approach that and then tell you as an economist what I'm looking at. When we look at the jobs data, there's not a whole lot of evidence that the jobs that are currently being cut is due to AI, right? We know that that's what companies are saying. At the same time, it's not really showing up in a clear way in the data. On the other hand, what we do really need to see is almost a discontinuous jump in the productivity data, right? So if we're sort of on this level increase, what we really want to see with AI is we're jumping up and then we're on a totally new level playing field. When we see that, and there should be early adopters in some key industries, I'm thinking, healthcare, consulting, finance, we should see those early signals and they should be showing up in the data.
As soon as 2026, you think?
That I firmly believe that's going to need to happen in 2026 in order for these valuations to be deemed worthwhile.
We're going to be getting into these big stories that are in the market today of how, at the moment, we continue to fuel the ever-needing expansion of AI infrastructure, whether it's Oracle selling debt and equity, whether or not Nvidia is going to be giving up to $100 billion or not to OpenAI. How are you seeing that narrative continue in 2026? Are we going to have to see a pullback in the amount that companies are committing?
I think it's more so we're really going to have to see the ROI in a meaningful way that we can go back to. And again, that gets back to productivity. So, and the risk really is, as we sort of pull all of these levers and they get more and more complex, it becomes a much more opaque environment, right, for investors to really operate in. And so the risk of those valuations maybe being artificially bolstered goes up.
Just from your perspective, the narrative of circular deals, is that actually, in many ways, we often put it in a negative context, but is exactly what Nvidia should be doing, investing in its own clients to be able to foster the potential ROI that we might see in this lockstep jump?
Yeah, I mean, absolutely, right? So if we see this truly meaningful transformation in the economy that's sort of promised with AI, then we're in a great spot, right? These circular investing schemes, that is excellent foresight by these companies. If we don't see that, right, that's the real risk of pretty significant market correction, right? Because that investing scheme, it is bolstering the overall revenue numbers that we're seeing.
What, therefore, are some more of the headwinds? Other than waiting for ROAI, we're also still tackling tariffs. We're still worried about South Korea's relationship with the United States, for example, in the here and now, let alone China. What could be the headwind that you're looking out for?
One headwind I'm particularly interested in tracking is actually jobs, right? So we're in a labor market overall when we talk about the macroeconomy that's quite soft. But when we speak specifically to AI, machine learning, sort of these high-powered tech jobs, we have a little bit of a bottleneck there. And so something really interesting that came out of the U.S.-Taiwan trade deal just a few weeks ago was this goal, right, of onshoring significant supply chain efforts from Taiwan to the U.S. In order to do that, we're also going to need significant changes in our workforce development. And there's a risk there, right, because we've had meaningful policy changes over the last year alone.
Fascinating take. Natalie Gallagher, come back soon, we hope, principal economist over at Board. Coming up, Elon Musk will is in advanced talks to combine SpaceX with XAI. We'll have all the details next. This is Bloomberg Tech. Checking in on Tesla shares. Well, we're seeing the impact of European sluggishness again. You saw it throughout 2025. We're down 2.5% as we understand European car sales of Teslas in particular slumped into 2026. In particular, absolutely plummeting. French sales down 42%. They only sold 661 cars. Norway registrations plunging 88%. But that's as we hear specific changes in policy over in Norway in particular. But look, generally, EV registrations are going higher in Europe, but just not for Tesla, whether it's a political read across or whether indeed it continues to be something around the brand and a slower adoption of older models versus the Chinese one. But let's move on to other areas of Elon Musk's empire right now, because we understand that he is in advanced talks to combine SpaceX with XAI. according to sources. A deal that would combine, of course, two of the largest closely held companies in the world. Just think, XAI is valued $200 billion. SpaceX is currently worth $800 billion at the last count. Bloomberg Deals team managing editor Leanna Baker joins us some more. There have been a lot of conversation about somehow his empire combining forces, whether it's Tesla and SpaceX or XAI and SpaceX. It looks like the latter is the more likely at the moment.
That's the idea that's gained traction in, late last week and over the weekend, that it looks like these two private companies, SpaceX and XAI, which also owns X, would come together. It's possible in the future Tesla could be involved. There's a lot of theories that one day there's just going to be one huge Elon Musk conglomerate. But for now, at least, it looks like this is the plan, and that SpaceX would still go public later this year.
I can see that the benefit for XAI is that it needs a ton of money. What is, in theory, the benefit to investors of both these companies by a combination?
A lot of this is futuristic. If investors in SpaceX want to see these data centers in space one day, which there's been some filings that could indicate maybe that's something they're working on, this is a way to bring that together. But definitely, is it a bailout of XAI, compared to SpaceX? Hard to say. We don't know any details on what is the structure right now, what shares will be transferred or exchanged or swapped for each other. So those details still need to come out to see, how shareholders make out.
And what sort of approvals do they need? Because we understand a lot of this has got investors' support, but do they need to? Can it just be done because Elon Musk thinks it's the right thing to do?
It's hard to say, but last year when X and XAI merged, it kind of just happened in an X post, and
and that's reality.
A lot of this, especially when there's private companies, the M&A is very much behind the scenes. Maybe an investment bank gets brought on for a fairness opinion, or there's certainly law firms, but it's hard to say. It's not like a public shareholder deal, or there might be committees, but a lot of it's done behind the scenes. And if Tesla had been part of this merger, then you might see more public information or independent board shareholder votes and whatnot. But this is all going to be happening kind of under the radar.
Briefly, who would run it?
That's a great question. XAI has brought on Anthony Armstrong, a former investment banker and who worked in the government. SpaceX has leadership in our reporting, doesn't have the answers, but there's certainly a few people in Elon Musk's sphere that could, potentially run this. Apparently, all his executives do everything at all the companies, so maybe it's just everyone.
Certainly, there's cross-pollination already. Leanna Baker is a great scoop that came out earlier today. We so appreciate it. Meanwhile, coming up, Oracle, it's racing to build out its AI infrastructure with plans to raise up to $50 billion. More on that next. This is Bloomberg Tech. Welcome back to Bloomberg Tech. We check in on these markets, a bit of a reprieve if you're in stocks and the dollar today, not so much if you're in gold and silver. We're up 0.9% on the Nasdaq 100 as we get a bit of a bounce back after a couple of days selling on big tech stocks. We're looking at Bitcoin at 79,000. Look, it's up on the day, but boy, was it sold off hard throughout the weekend. Once again, we're questioning people's desire for risk assets more broadly at these sorts of valuations. Digital gold has not been particularly loved. Meanwhile, gold got absolutely hammered on Friday and continuing into Monday. But let's look at some of the other areas of focus when it comes to individual stocks on the moon, because underneath the hood, Nvidia has been one of the ways down in terms of points. We're going to dig into why Nvidia is perhaps reassessing how much it's going to be committing to OpenAI's infrastructure build-out, how it commits to that as well. But we also see how Oracle is up 2.5%, having brought a little bit more transparency as to what they need to raise for its own AI infrastructure, largely for OpenAI. Bonds, stock, the sales are upon us already. Bloomberg's Brody Ford joins us, who was working hard all weekend because it was on a Sunday that we learned that here's a company that's looking to raise, up to $50 billion in a mixture of equity and debt?
Sunday night, it's time to raise more money. Yeah, it was kind of a unique situation to have this kind of large announcement from a company as mature as Oracle on a Sunday. But what that really underscores is how Oracle's become this poster child of all the AI financing fears. It's expected to be negative free cash flow for the next couple of years as it builds massive data centers. And the big question has been, how much money will they have to borrow to do that? Will they be able to maintain their investment grade? And they essentially were trying to respond to these concerns and say that, no, we have a solid plan.
And it's interesting, maybe they've been learnt from past haste with a previous bond sale at the end of last year, where bondholders are now suing because they felt that they didn't get enough, clear transparency that this was a company that will be tapping the debt market a lot. When we're looking at what we're getting today, though, there's 3-year floating rate notes, there's 3-year fixed, 5-year fixed, 7-year fixed, it's a long 7-year, 10-year, 30-year, 40-year. How much are they having to pay for the debt side of the equation, which they actually say is the only time they're going to be tapping the bond markets this year?
Well, they're expected to get a ton of free cash flow once you look a couple of years out, once those OAI contracts and others start flowing. And what's particularly interesting today is to see them issue equity. And often when that happens, investors don't like dilution and the stock goes down. So it's funny to see the stock go up on an equity issuance. And what that means is that the company is willing to do what it takes to keep investment grade. It does not want to get saddled with some incredible interest rates. We've heard a lot of concerns on these loans, and so they're trying to show that they're going to do what it takes to maintain a good rating.
And actually, that was really what we heard from the analyst space coming out here, saying this should be a positive sign, that they are really committed to avoiding junk.
Absolutely. And I think what it is, too, is just clarity. I mean, there's been so much uncertainty about, hey, is Oracle going to be able to get all of the loans it needs? Is it going to be able to complete this build out seamlessly? Is OpenAI going to pay its bills? That's a lot of the questions that have been weighing on the stock. And so kind of any new information that shows a specific plan, almost whatever that plan is, as long as it seems reasonable, is going to be read as good news.
We'll see how the up to $25 billion bond sale goes today, and indeed some of those convertible notes as well. Brody Ford all over the Oracle story. And let's stay with the AI-related debt story now, because the cost of data center build-out, it is expected to top $3 trillion. And Oracle isn't the only tech company borrowing to finance their plans. Bloomberg's senior private credit reporter, Paula Seligson, joins us now, who you've been looking across the board at the panacea, all the ways in which companies are trying to finance an extraordinary amount of build-out right now. How much are they leaning on public bond markets or indeed the rest of the debt system?
So the best way to think about this is they are tapping all debt markets. So we have obviously the typical on-balance sheet corporate borrowing, which you see like with the Oracle deal today. That can be an investment grade bond, a high yield bond, or a leveraged loan, or even a private credit direct loan. But there's a lot of off-balance sheet borrowing happening as well. I know that sounds a little bit scary when you first hear the words off balance sheet, but what it simply means is that instead of an investor lending to the company, they're lending to the actual data center project itself. So they create a special purpose vehicle that is the actual builder and owner and borrower to create the data center. When you tap that, that opens up a whole other realm of markets. So for example, the bank project finance construction loan market has been heavily involved in this space. You're seeing private placements, which are typically insurance companies. You're seeing structured finance investors in the form of commercial mortgage-backed securities and asset-backed securities. You're seeing private credit. You're seeing GPU finance for the chips. It is touching all parts of the debt markets.
And we think about, CoreWeave was very much thinking about financing of the chips to begin with. We saw that deal between Blue Owl and Meta was a real pin-up in the private part of their business. What are they having to pay for all of this, Paula?
It really depends, and it can range from just a little bit over investment grade all the way to double-digit teens, mid-teens yields. It just kind of depends on the structure. There's also a big difference between something that is a hyperscaler borrowing or ultimately backed by a hyperscaler versus some of the more risky things where maybe it's a small early stage company that needs to borrow money that's all in on AI.
We've had a lot of new neoclouds popping up, for example. Just tell us about the need for transparency, though. What's so interesting is the equity market's response to Oracle today is just few. You're telling us a little bit more. When we have so much private credit getting involved, do investors feel they have enough information about just how broadly the borrowing is going from certain issuers?
I think it depends on the issuer. So Oracle, for example, while it is doing this off-balance sheet borrowing, it is still tied to those data centers through lease commitments, and that does show up publicly in their financial statements. But I think for a lot of these deals, it's actually pretty much all private. It's also a lot of times private companies doing it. So then the investor base is just a very different investor base, and I hope they're getting disclosures, but it's unclear. And I think what makes it nerve-wracking for the markets is even if those private company investors are learning about it, maybe the rest of the market doesn't know. And that can just cause unease and uncertainty around the absolute scale of the debt being borrowed right now.
Well said. Bloomberg's Paula Seligson. Got to go and read her author's throughout all about the debt markets. Really interesting stuff. Meanwhile, let's go to other AI build-out. Nvidia CEO Jensen Huang says the company's proposed $100 billion investment in OpenAI was, quote, never a commitment. Speaking to reporters in Taipei over the weekend, Huang reiterated his support for the ChatGPT maker, but did not disclose the total investment. Just take a listen.
Sam is closing the round, and we will absolutely be involved in
How much? Can you say how much? Can you say how much?
We will invest a great deal of money, probably the largest investment we've ever made.
The large?
Yeah.
So is that going to be over 100 billion?
No. Nothing like that.
Seth Fiegerman joins us now for what was a busy weekend, as always, for Mr. Huang over in Taipei. Look, are we meant to be surprised that when you've inked some sort of deal and said, look, we're good for up to $100 billion, that actually that hasn't been fully ironed out and agreed, and it's up to each megawatt coming online?
A little bit. I mean, I think it's important to step back and remember when this deal was announced a few months back, it was a monumental moment for both companies, one that attested to the scope of the build-out that OpenAI had in mind and NVIDIA's role in that, and also a lot of the circular deals concerns. To your point, there was a lot of daylight there. They never set a firm timetable or a fixed amount, and so there was room to imagine that maybe it wouldn't be $100 billion. But now I think it's a question of just how far away is it from that, and again, over what timetable.
Some of the reporting from other networks and outlets has been that actually NVIDIA is getting uncomfortable with the competitive landscape, uncomfortable with the so-called discipline of OpenAI. Is that something that we're hearing in our reporting, or is this more, this is a company that's maybe is aware of the criticism around circular financing and is just being questioning a little bit more?
Yeah, I mean, it's unclear, and it's a delicate balance here between these two companies. Even if NVIDIA is maybe having those concerns that you laid out, OpenAI is still very central both to the larger landscape and to NVIDIA's own deployment of chips. It's clear that the relationship between these two firms has not broken down. As Jensen said, will probably be the largest investment they've ever made and will probably be the largest funding round we've ever seen. But it's possible there is some daylight there.
Let's just go to that funding round, because that's what's currently under negotiation. We know that Middle Eastern investors has been eyed up. We know that Amazon's interested in the round. So what sort of scale are we talking, and how will it be related to using certain companies' equipment or gigawatts coming online, do you think?
Yeah, so I mean, we've reported that up to $100 billion in this funding round, which again would be the largest that we've ever seen, trumping OpenAI's prior $40 billion funding rounds. We've seen that Amazon, SoftBank, NVIDIA, each willing to potentially commit billions or tens of billions of dollars to this round. Does not currently feel like OpenAI is hurting for money in that one respect. Remains to be seen. And then to your question, not just NVIDIA, but certainly Amazon, Microsoft, like these are all, if not circular relationships, then continued examples of the companies using the suppliers to fund their ambitions.
Well, we'll keep a track of it. Seth Fiegerman breaking it all down on that relationship between NVIDIA and OpenAI. Meanwhile, coming up, let's talk about crypto exchanges. They're under pressure. Plunging trading volumes is really the issue. At the moment, we're off by just a couple of percent. We've recouped some of our losses on the day, but we'll dig into it next. This is Bloomberg Tech. Bearish sentiment in crypto, it is weighing on the exchanges. As investors pull back on trading platforms like Coinbase and Gemini, well, they're seeing stock prices and trading volumes drop. For more on the entire ecosystem, let's bring in Bloomberg cross-asset reporter Isabel Lee. And no wonder companies exposed to trading and volume are going to be feeling the pain when everyone probably takes a bit of a step back at this moment.
Definitely a step back. I was sitting in my sofa nicely over the weekend, and then Bitcoin fell. It fell to its lowest since April, the tariff-driven volatility. So it made a lot of investors panic. Granted, thin liquidity over the weekend and fewer traders, fewer online. And we know that when Bitcoin falls, it triggers a wave of liquidations. We saw billions and billions of long and short positions liquidated. But still, investors have been increasingly becoming a little unhappy with Bitcoin because macro factors that used to help it before haven't been really helping, like a weaker dollar. That's supposed to be good for Bitcoin, but it's not really helping right now. So now we're seeing January decline, and it's really one of the longest streaks. I think it's a fourth straight monthly decline, the longest streak since 2018.
I mean, Bitcoin shed nearly 11% in January. At one point, it was trading the lowest since President Trump's return to the White House. Much had been hoped for regulatory changes, in particular what might get through Congress. That seems to have been put on ice. Is that also an issue?
Definitely. It's put on ice because if this president, which is supposed to be the most crypto-friendly president, can't help it, what can? And you also see it in flows. Flows are drying up. I mean, sure, it's just a bucket. And this, we still have more than $1 billion in assets. But you see flows drying up. I think investors have been spoiled because it used to be always green on the screen, inflows after inflows. When Bitcoin ETFs launched in 2024, which is crazy, it's 2 years ago, it made records after records. And now, I mean, some would say it's consolidation. Some would say, oh, great, now I can buy it. It's an attractive entry point because for a while, Bitcoin has been too high, and if it's too high, I mean, how will that be an attractive entry point? So it's a mixed sentiment out there, but for now you can't deny that there's some gloom in crypto world.
Some blue for Michael Saylor in particular. I mean, just talk to us about these digital asset treasury companies and how much this pain must be hurting them.
Just like Bitcoin, I think digital asset treasuries are, whether you love them or you hate them, but today headlines are making for Michael Saylor because for the first time, the plunge, token's price fell below the purchase cost of Michael Saylor's leveraged Bitcoin proxy and strategy. So that's really something. There are no margin calls yet. I want to make sure there's no immediate financial stress, no expectation to sell Bitcoin, but it's just something worth noting. Could this be the beginning of something? Maybe, but maybe it's also just like a bad day, a bad week, a bad month, but it's definitely worth noting because he is the biggest bull of Bitcoin on Wall Street.
Yeah, the company's cost basis is about 76,000 and we went below that for a moment.
Yes.
I mean, we see the stock price just get off of its lows, but still under pressure once again. Isabel Lee, across this asset class for us. We appreciate it. Now coming up, Palantir earnings. They come up after the bell. We're going to discuss what to expect. This is Bloomberg Tech. Earnings still coming, all eyes on Palantir reporting after the closing bell today. And actually, for the first time in 2 years, Palantir shares are not rallying into a quarterly earnings report. Let's break it all down. Bloomberg's tech equity reporter, Carmen Reinecke. On the day, they're up just a little bit. But year to date, it's been brutal, right?
It has, and if you look even further back to November, when they hit their record high ahead of their last earnings report, the drawdown is about 25%, which is pretty significant for Palantir, for any stock, and a very different setup that we've seen going into earnings from previous reports. So it's definitely looking like, you know, the stock could get a little bit of help. Its valuation is still very high, even though it's come in a little bit with this, you know, the stock's decline. So investors are looking for some very key things. I mean, Palantir is expected to put up another great quarter. The guidance will really be paramount. And there's a lot of volatility in this name, so we could really see big swings in either direction.
I mean, revenue's still meant to be 61% growth, more than 50% for the fiscal full year. Mm-hmm. But Dr. Karp's got to be aware of how he in many ways is deemed a bit of a meme stock, and as we've just been discussing with crypto and Bitcoin, we've seen a lot of changes in where people have been wanting to allocate. Is that anything to do with it, or is it more about just a terrible time for software in general?
I think it's a little bit more tied to the software, you know, sell-off. We've seen a couple analysts commenting on that. It's just gotten weighed down with the rest of the sector. I think there also could be, you know, there's been some of a rotation away from, you know, the most expensive tech names. This definitely is in that camp. And, you know, a source said to me, if you're looking to rotate and something's over 100 times, you know, forward earnings, that's not really maybe the place that you're going to be looking to buy. So, yeah, we'll just really see. I think Dr. Karp as well, you know, he's such a passionate CEO. People will definitely be listening for his comments on the call, and that could, you know, really go either way as well.
We always get some pretty choice words from Dr. Karp. Bloomberg's Carmen Reinecke, great to have you on today. Thank you. Look, Palantir isn't the only big tech name reporting earnings this week. Look how many we've got coming. I'm pleased to say Fiona Cincotta, senior analyst at Citi Index Financial, can talk us through. We've got AMD on Tuesday, Qualcomm, Alphabet Wednesday, Thursday. You've got the big one that is Amazon. Fiona, how do you brace for some of these numbers? Because, look, Microsoft last week wasn't a bad set of numbers, absolutely beaten up when people were worried about the capital expenditure.
Yeah, that's right. I mean, we're definitely seeing this sort of division between those tech that are in favor and those that are not. And I think that's going to be even more under the microscope as these earnings come through. The market is very much more selective about where they're looking to direct capital. You know, before, as we said, it was just very much more jump on that tech trade and ride it higher. There really wasn't too much in it, but that's just not the case anymore. And we're seeing seeing, even numbers that come out relatively good, like we said with Microsoft, end up with, a 10% drop in the stock. And at the same time, we saw Meta driving 10% higher. So it does feel a little bit more unpredictable in that respect. And it also means that the bar, I would say, is even higher on these companies to impress than it has been before, even though valuations in some cases have come down a bit, given that sort of sellout of tech that we had seen since the November highs.
So let's just start with Palantir, for example. What would a software company that is going to deliver more than 60% earnings per share growth, more than 60% revenue growth, have to articulate, do you think, to change the sentiment on the name?
I mean, I think forward guidance is going to be absolutely key. And I feel that's where sort of, Microsoft might have just sort of let the side down a little bit compared to Meta, for example. So I think forward guidance is going to be massively impressive in order to support this valuation. I mean, as we spoke about, the valuation here is 140 times expected earnings. So, it really has a lot to live up to. And given that we've seen all these questions about the AI spend, capital expenditure, what's the monetization, this does mean that investors do actually want to see that something's coming through now. And for that reason, I think forward guidance is going to be key here.
Yeah, if anyone can show productivity and articulate what AI is doing, Palantir could likely do that. Meanwhile, Alphabet's that one-stop shop, vertically integrated, showing what it can do with its own chips, doing what it can do with its own tech and hardware and the whole shebang. Fiona, what do you anticipate? Alphabet has had a lot of mood music to the positive of late. Will that hold?
Yeah, so I mean, I think this is definitely one of the stocks that seems to be in the favoured few. I mean, if we look, it's up 8% across January, which is, pretty good returns for a tech stock in January, up 68% year on year. But I think, Amazon, and again with, Alphabet again with Amazon are going to be very much a litmus test as far as that whole sort of, AI theme is concerned. Obviously, with Alphabet, you're looking at a $4 trillion valuation. So, investors are really going to want to see whether there's momentum in that Google Cloud and advertising to support that valuation. So, focus, as I said, will be on that cloud growth, will be on AI initiatives, monetization of that, and also spending. I mean, this is what, the market has been getting very nervous about is, what is that AI spending? What are we looking at? How much is it expected to go up? And what are the returns on the back of that?
What's interesting is both Alphabet and Amazon will be a bit of a tell for Nvidia, maybe AMD as well, which is coming out beforehand, of how well are they producing their own chips? How much does that matter to Nvidia in the future? I mean, we don't get their earnings until later in February, as always, Fiona. But do you think semiconductor concerns should start to build in terms of companies being able to build their own and just turning to a Broadcom, for example?
Yeah, I mean, it's definitely a question that's on the table and a focus that will be there. And I mean, if we do see that happening, then obviously that will move attention away from Nvidia and that sort of, first to market momentum that stock had. I don't think we're necessarily there yet, but I think it is right to expect that to slowly start creeping in. So attention will be on that as well. As you said, Nvidia not for a little while yet, but it's always a massive focus as we get past these earnings this week.
How many calls are you taking also about the private side, the question marks around OpenAI's fundraising and what that really means to the rest of the ecosystem to your public investors for a moment?
It's definitely a question, and it's that question that we had, and it was very much a concern, I think, around October, November time, where there seemed to be a lot of deals going on, and there was that sense of, or that question, is this sort of an ecosystem that's growing, or is it just circular investment? And I don't think that was ever really resolved. The market does seem to be a little bit calmer about those questions for the time being, but I wonder if as we move towards Nvidia's, whether those questions will start to appear again, and especially after we've had the earnings this week.
Fiona Cincotta, bracing us for a big week at Citi Index Financial Markets. Thanks so much for your time, as always. Meanwhile, that does it for this edition of Bloomberg Tech. Do not forget to check out our podcast. Find it on the terminal, as well as online on Apple, Spotify, and iHeart. From New York, this is Bloomberg Tech.